Before we dive in, please remember that the information in this video is for educational purposes only. I am not a financial advisor, and this presentation is not financial advice. The cryptocurrency market is highly volatile and carries significant risk. You should always do your own research and consult with a qualified professional before making any investment decisions. Your capital is at risk. You've heard the names: Bitcoin, Ethereum, maybe even Dogecoin. You see the headlines flash across your screen. Fortunes made and lost in the blink of an eye. You hear your friends, your coworkers, even your cousin who still lives in his parents' basement, talking about their crypto portfolio. And as you listen, a quiet, nagging question starts to form in the back of your mind. Am I missing out? Am I too late to the party? Is this whole thing just some giant, complicated digital casino that I'm not smart enough to understand? The answer to those questions in order is maybe, absolutely not, and definitely not. The truth is, the world of cryptocurrency feels intentionally confusing. It's filled with jargon like blockchain, decentralization, and proof of stake that makes normal people feel like they need a computer science degree just to get started. But I'm going to let you in on a little secret. That complexity is a myth. If you can use a banking app on your phone, if you can order something from Amazon, you have all the technical skills you need to buy your first cryptocurrency securely and confidently right here in the United States. This video and this entire series is your antidote to the confusion. This is not another lecture about abstract technology. This is a step-by-step, click-by-click blueprint designed specifically for Americans. We are going to cut through the noise and give you a simple, actionable plan. By the end of this series, you will go from zero knowledge to confidently owning your first piece of digital currency. You'll know what you're buying, where to buy it safely, and how to keep it secure from hackers and scammers. To do that, we need to build a solid foundation. Forget everything you think you know, and let's focus on 3 core pillars that will support your entire journey into this new world. Pillar number 1 is the what. What is cryptocurrency, really? Pillar number 2 is the where. Where, in the United States, can you legally and safely buy it? And pillar number 3 is the how. How do you actually convert your US dollars into something like Bitcoin? Let's start with pillar 1, the what. Don't worry, I'm not going to bore you with a technical breakdown of blockchain technology. The only thing you need to understand for now is this: cryptocurrency is just a new type of property you can own, like a stock, a bond, or a piece of gold. But instead of being a piece of paper or a shiny rock, it's purely digital. Let's use an analogy. Think about Apple's stock. When you buy a share of Apple, you're not getting a physical piece of the iPhone factory. You're getting a digital entry in a ledger that says you own a tiny fraction of the company. You believe that as Apple grows, invents new things, and becomes more valuable, the price of your share will go up. Now think about Bitcoin. Bitcoin is the original cryptocurrency. When you buy Bitcoin, you're buying a tiny piece of a global, decentralized financial network. There will only ever be 21 million Bitcoin in existence, period. That scarcity is built into its code. It's like digital gold. People buy it because they believe that as more people and institutions want a piece of this limited supply, its value will increase over time. It's a bet on the future of a new kind of money. Or think about Ethereum. Ethereum is different. It's more like a global supercomputer that isn't owned by any single company. Developers can build applications on it, from new financial systems to video games. When you buy Ether, the currency of the Ethereum network, you're essentially buying a piece of that global computer. You're betting that as more useful applications are built on Ethereum, the demand for its currency will go up. It's more like owning a share in the foundational infrastructure of a new internet. That's it. That's all you need to know for now. Some cryptocurrencies are like digital gold, a store of value. Others are like shares in a new technology platform. They are simply digital assets that you can buy, hold, and sell. Don't let anyone complicate it more than that. Now for pillar 2, and this is critically important for anyone watching in the US. The where. Where do you actually go to buy this stuff? You don't call up your stockbroker. You go to a place called a cryptocurrency exchange. Think of it like a stock market for digital assets. It's a platform where you can trade your US dollars for Bitcoin, Ethereum, and other coins. But here's the most important rule you will learn in this entire video. Not all exchanges are created equal. You've probably seen headlines about exchanges collapsing, losing customer funds, or getting shut down. Nearly all of those horror stories happen on unregulated, offshore platforms. As a US resident, you have a massive advantage. You have access to exchanges that are regulated right here in the United States, often at the state and federal level. Your mission is to only use a reputable US-based exchange. The big three for beginners in the US are typically Coinbase, Kraken, and Gemini. These companies are based here, they comply with US banking laws, and they have a long track record of security. Coinbase is even a publicly traded company on the NASDAQ, just like Apple or Microsoft. They have to answer to the SEC. This provides a layer of accountability and safety that you simply do not get with some random exchange based in a country you've never heard of. Choosing a US-regulated exchange is your #1 line of defense. It's the seatbelt you buckle before you even start the car. In a later part of this series, we'll do a deep dive and compare these platforms so you can pick the perfect one for you, but for now, just burn this into your brain: Coinbase, Kraken, Gemini. Stick to the home team. Finally, we have Pillar 3, the how. This is the part that scares people the most, and ironically, it's the easiest part of the entire process. Once you've chosen your US-based exchange, the process looks almost identical to opening a new bank account or a Robinhood account. You'll sign up with your email. You'll verify your identity by uploading a picture of your driver's license or passport. This is a legal requirement in the US called KYC, or Know Your Customer. It's designed to prevent money laundering, and it's a good thing. It's a sign that you're on a legitimate platform. After that, you connect your funding source, which is usually your US bank account or a debit card. And then you just buy it. You type in, "I want to buy $50 of Bitcoin." You click a button and congratulations. You're a cryptocurrency owner. It's that simple. We will walk through this exact process screen by screen in a future part. So let's recap our 3 pillars. The what? It's just digital property like digital gold or a share in a new tech platform. The where? A US-regulated exchange like Coinbase, Kraken, or Gemini. The how? A simple sign-up process that's as easy as opening a bank account. Now let's address the elephant in the room. The big question you're probably still asking yourself. Is it too late? Did I miss the boat on Bitcoin when it was $1 or $10 or $10,000? Let me reframe that question for you. Asking if it's too late is like asking someone in 1995 if it was too late to get into the internet. At the time, the internet was slow, clunky, and confusing. Most people thought it was a fad for nerds. They said, "Why would I ever need email? I have a phone. Why would I buy something online? I can just go to the store." They saw it as a weird speculative toy. They didn't see it as the foundation for Amazon, Google, Netflix, and the entire modern economy. The people who took the time to understand the internet in 1995, even just a little bit, were positioned to capitalize on the single greatest wealth creation event of the last century. They weren't necessarily late or early. They were simply curious and willing to learn. That's where we are with cryptocurrency right now. We are in the dial-up phase of a brand new technology. It can be slow. It can be clunky. And most of the world still thinks it's a speculative toy. But underneath the surface, a new financial infrastructure is being built, piece by piece. By learning the absolute basics today, what it is, where to buy it, and how to do it safely, you are positioning yourself not to get rich quick, but to understand and potentially participate in the next major technological shift. You are not late. You are still incredibly, remarkably early. By the end of this video, you will have a crystal clear roadmap. You'll know exactly what you need to do, which platform you're going to use, and why this might be one of the most important financial decisions you explore this decade. Let's start by digging deeper into the single most important choice you will make on this journey: selecting the right exchange for your specific needs as an American investor. Think of a cryptocurrency exchange as the digital version of the New York Stock Exchange, but instead of trading stocks like Apple or Tesla, you're trading digital assets like Bitcoin and Ethereum. And just like you wouldn't trust a shady, back-alley broker with your life savings, you absolutely cannot afford to make the wrong choice here. This isn't just a website. It's your bank, your vault, and your gateway to the entire crypto ecosystem. Choosing the wrong one can lead to sky-high fees, frustrating experiences, or in the worst-case scenario, a total loss of your investment. But choosing the right one makes the entire process secure, simple, and even enjoyable. For Americans, the field is narrowed down by regulation, which is a good thing. It weeds out the untrustworthy players. Right now, there are 2 titans that stand out for beginners, each with a completely different philosophy: Coinbase and Kraken. Understanding the difference between these two is the key to starting your journey on the right foot. Let's start with the 800-pound gorilla, Coinbase. If cryptocurrency had a mainstream household name, it would be Coinbase. Think of it as the Apple or the Chase Bank of the crypto world. It's designed from the ground up with one person in mind: you, the beginner. Their entire mission is to make buying digital currency as easy as ordering a book from Amazon. The interface is clean, beautiful, and ridiculously intuitive. You don't need to understand order books or liquidity pairs. You just see a price, type in how much you want to buy, and click a button. It's that simple. But the real reason Coinbase is the default on-ramp for millions of Americans is trust. Coinbase is a publicly traded company on the Nasdaq Stock Exchange under the ticker symbol SIN. This is a massive deal. It means they are subject to the same rigorous financial scrutiny and reporting requirements as companies like Microsoft and Google. They have to open their books to the SEC. This level of transparency is almost unheard of in the often shadowy world of crypto exchanges. For a new investor, that's a powerful security blanket. Furthermore, any US dollar balances you hold on Coinbase are FDIC insured up to $250,000, just like a traditional bank account. They also have a massive private crime insurance policy that covers their crypto holdings against theft from a hack or a breach. This multi-layered approach to security provides a level of peace of mind that is hard to put a price on. So what's the catch? Well, that peace of mind and simplicity comes at a cost. Literally, Coinbase's biggest drawback is its fees. For the convenience of those simple one-click buys, you will pay a premium. Their fee structure can be a bit confusing, combining a spread, which is a small margin built into the price you see, and a separate Coinbase fee. For small purchases, this can add up to a significant percentage. It's the classic trade-off. You are paying for convenience, security, and ease of use. For many people just starting out, that trade-off is absolutely worth it. If your goal is to simply buy $100 of Bitcoin and hold it for the long term, the slightly higher fee is a small price to pay for a seamless and secure experience. Now let's pivot to the other giant, Kraken. If Coinbase is the elegant, user-friendly Apple, then Kraken is the powerful, customizable PC built for gamers and professionals. Founded way back in 2011, Kraken is one of the oldest and most respected exchanges in the world. They've built their reputation not on slick marketing, but on rock-solid security and a professional-grade trading experience. Their biggest claim to fame? They have never ever been hacked. In an industry where exchange hacks are tragically common, that track record speaks volumes. The first thing you'll notice about Kraken is that it feels more like a traditional stock brokerage. The interface gives you more data, more charts, and more options. This can be a little intimidating at first, but it also means you have a platform you can grow into. The primary advantage of this professional approach is, you guessed it, much lower fees. Kraken uses a maker-taker fee model, which sounds complicated but is actually simple. All it means is that they reward users for providing liquidity to the market, and even for standard market orders, their fees are typically a fraction of what you'd pay for a simple purchase on Coinbase. If you plan on being more active, or even just dollar cost averaging on a regular basis, the fee savings on Kraken can become substantial over time. Kraken also shines in its commitment to transparency and security. They were the first major exchange to pioneer something called a proof of reserves audit. This is a cryptographic method to prove that they hold all of their customers' funds, one-to-one, and aren't secretly lending them out or using them for other purposes. It's a voluntary audit that demonstrates their financial integrity, a practice that has become an industry gold standard. So what's the downside to Kraken? The learning curve. It's not impossibly steep, but it's definitely not the one-click simplicity of Coinbase. You'll need to learn the difference between a market order and a limit order. You'll need to navigate a slightly more complex funding process. It's not hard, but it requires a little more effort and attention up front. It's built for someone who is a little more cost-conscious, a little more tech-savvy, and who wants more control over their trades. So we have two clear paths. Coinbase, the ultimate in simplicity and user-friendliness, but with higher fees. Kraken, the professional's choice with low fees and robust features, but a slightly steeper learning curve. Now, you might have heard of other big names like Binance.us or Crypto.com. Let's briefly touch on those. Binance is the largest crypto exchange in the world, but its US arm Binance.us is a separate entity that has faced significant regulatory headwinds and challenges. While it often boasts the lowest fees and a massive selection of coins, navigating its ecosystem can be complex, and its regulatory future in the US has often been uncertain. For a beginner, it represents a level of complexity and potential headache that I simply cannot recommend. Crypto.com, on the other hand, is the one you've seen everywhere, sponsoring the Super Bowl, Formula One, and even renaming the Staples Center in Los Angeles. They are focused on building an all-encompassing crypto lifestyle brand, with a popular crypto-backed debit card as their flagship product. While they are a legitimate and regulated option, their app and fee structure are often criticized for being less transparent and less user-friendly than the competition. They're a valid choice for someone who wants to go all in on that specific ecosystem, but for your first simple purchase, Coinbase or Kraken are far more straightforward. So how do you choose? Comes down to a simple question. What kind of person are you? If you are the type of person who just wants to get started with zero friction, who values security and ease of use above all else, and you're willing to pay a small premium for that white glove service, the answer is Coinbase. Hands down. If you are the type of person who is fiercely independent, who likes to look under the hood, who is focused on minimizing costs, and you aren't afraid of a slightly more professional interface, the answer is Kraken. My advice for over 90% of people watching this video? Start with Coinbase. Why? Because the biggest hurdle in any new venture is just getting started. Coinbase removes nearly every point of friction. It makes the process feel safe and familiar. Think of it this way. You learn to drive in a reliable automatic transmission Toyota Camry, not a high-performance manual shift Formula One car. Coinbase is the Toyota Camry. It will get you on the road safely and reliably. Once you're comfortable driving, you can always test drive the race car later. You can always open a Kraken account down the road when you feel more confident and want to save on fees. The goal right now is to cross the starting line without tripping. Your homework before we move to the next part is simple. Don't sign up for anything yet. Just open 2 tabs in your web browser. Go to coinbase.com and kraken.com. Look at their homepages. Click around the About Us and Security sections. Get a feel for their language, their design, and their philosophy. See which one resonates with you. Because in the next part, we are going to roll up our sleeves and walk through the entire sign-up and identity verification process, step by step, turning you from a curious observer into a verified investor, ready to make your first purchase. Alright, let's do it. Grab your phone or pull up a chair to your computer, because this is where the theory ends and the action begins. We're going to build your bridge into the world of crypto, and the first plank in that bridge is creating and verifying your account. For this walkthrough, we'll be using a major, reputable US-based exchange. The specific buttons might look a little different depending on which one you chose, but the core process, the information they require, is virtually identical across the board. This is the industry standard. First things first, you'll navigate to their homepage and hit that big, bright Sign Up or Get Started button. The initial step is always the easiest, the one you've done 1,000 times before. You'll enter your email address and create a password. Now stop. Before you type a single letter into that password box, I want you to listen very carefully. Do not use a password you have ever used for any other website. Not your email password, not your social media password, not the one you used for that pizza delivery app 6 years ago. Your exchange account will hold real, valuable assets. It needs a unique, fortress-like password. We're talking at least 12 characters, a mix of uppercase letters, lowercase letters, numbers, and symbols. Write it down on a physical piece of paper and store it somewhere safe. And please, enable two-factor authentication the moment the platform allows you to. We'll cover that in more detail in just a minute, but it is the single most important thing you can do to protect your account. Okay, email in strong password set. You'll get a confirmation email. Click the link and you're in. But you're not really in. You're in the lobby. You can look around, but you can't do anything yet. To actually buy, sell, or trade, you need to become a verified user. This next stage is where people sometimes get a little hesitant. It's called KYC, which stands for Know Your Customer. This isn't the exchange being nosy. This is a legal requirement. In the United States, any legitimate financial institution that deals with money, whether it's a bank, a stock brokerage, or a crypto exchange, is required by federal law to verify the identity of its customers. This is to prevent things like money laundering and other illicit activities. I want you to reframe how you see this. Don't see it as a hassle. See it as a giant glowing green flag. An exchange that requires KYC is an exchange that is complying with US law. It's a sign that they are a serious regulated business, and that actually adds a layer of safety for you, the consumer. Unregulated exchanges that don't ask for this information might seem easy, but they are operating in the shadows, and you have zero protection if something goes wrong. So what do you need for this process? Go ahead and grab your wallet right now. You will need a government-issued photo ID. For most of us, that's going to be our driver's license or a state ID card. Passport works too. You will also need your social security number. Ready? Let's walk through it. The system will now ask for your personal information. First, your full legal name. This is critical. Enter it exactly as it appears on your ID. No nicknames, no abbreviations. If your middle name is on your license, put your middle name in the form. Next, your date of birth. Simple enough. Then your home address. Again, this must be the address that's on your ID, or that can be verified through public records. And now the big one, your social security number. I know, I get it. We're all taught from a young age to guard that number with our lives. Giving it out online can feel wrong. But you have to remember the context. You are not signing up for a form or a social media app. You are opening an account with a financial institution. The same reason you give your SSN to Fidelity to open a stock account, or to Bank of America to open a checking account, is why you're giving it here. They are required by law to collect it for identity verification and for tax reporting purposes with the IRS. As long as you are on the legitimate exchange's official website, check for the little lock icon in your browser's address bar. This information is being transmitted securely. Once you've entered all that data, the final proof is required. This is where you'll need that ID you grabbed earlier. The platform will ask you to upload images of it. Most will want a picture of the front and a picture of the back. My advice here is simple but crucial. Use your smartphone. The camera is great, and the exchange's mobile app usually makes this process seamless. Find a well-lit area. Lay your ID on a flat, dark surface to create contrast. Make sure there's no glare from a light overhead. Hold your phone directly above it and take a crystal clear picture. All four corners of the ID must be visible in the frame. If the picture is blurry, if there's a glare, if a corner is cut off, an automated system will likely reject it, and you'll have to do it all over again. So take a moment to get a perfect shot. After you upload the front and back, get ready for your close-up. The next step is usually a liveness check or a selfie verification. You'll have to use your phone or webcam to take a picture of your face. Sometimes it's a still photo, other times they'll ask you to turn your head slowly from side to side. This is the exchange's way of proving that the person holding the ID is the same person in the ID photo, and that you are a real, live human being opening the account right now. Again, good lighting is your friend. No hats, no sunglasses. This isn't for your next profile picture. Just make sure your face is clear and visible, and then you wait. Sometimes verification is almost instantaneous. An automated system checks your data against public records, analyzes your ID photos, and gives you a green light in under 5 minutes. Other times, especially during periods of high demand, it might need a manual review by a human, which could take a few hours or, in rare cases, a day or two. Don't panic if it's not instant. Just be patient. Then you'll get it. The email. The notification you've been waiting for. The subject line will say something like, "Congratulations, you're verified." Or, "Your account is ready." That email is your key. It's your official entry pass. It's the moment you go from being someone on the outside looking in to someone with a seat at the table. You now have a fully functional, verified account on a major cryptocurrency exchange. But we are not done. Before you even think about putting a single dollar into this account, we have to lock it down. We have to build the walls of the fortress. Go to your account settings and find the Security tab. You will see an option for two-factor authentication or 2FA. We are going to enable it right now. The exchange will likely give you two options: SMS-based 2FA, where they text a code to your phone, or Authenticator app 2FA. I'm going to be very direct. Do not use SMS. While it's better than nothing, it is the less secure option. Hackers can use a sophisticated technique called a SIM swap attack, where they trick your mobile carrier into transferring your phone number to a SIM card they control. If they do that, they get your text messages, including your 2FA codes, and they can drain your account. Instead, you are going to use an Authenticator app. Go to your phone's app store and download Google Authenticator or Authy. They're both free and highly respected. Back on the exchange, select the Authenticator app option. It will show you a QR code on the screen. Open your new Authenticator app, hit the plus sign to add an account, and point your phone's camera at that QR code. Your app will immediately recognize it and add a new entry for your exchange account, which will display a constantly changing 6-digit code. Now, here is the most important step of this entire process. The exchange will also show you a backup key, or secret phrase. It's a long string of letters and numbers. You must write this down on a piece of paper. Do not save it as a screenshot. Do not email it to yourself. Do not save it in a text file on your computer. If your phone is lost, stolen, or broken, this physical piece of paper is the only way you will ever be able to regain access to your authenticator and your exchange account. Write it down, double-check it, and put that piece of paper in a safe, a locked drawer, or somewhere it will never be lost or accidentally thrown away. Treat it like the deed to your house. Once you've secured that key, the exchange will ask you to enter the 6-digit code from your app to finalize the setup. Do that and you're done. Your account is now a fortress. It has a unique password and a second, independent security layer that only you can access from your physical phone. You are now a verified user on a major cryptocurrency exchange. Your account is secure and it is ready. But a fortress with an empty treasury isn't much use. In the next part, we're going to open the gates and fund your account. We'll break down the different ways to get your US dollars from your bank into the exchange, the pros and cons of each method, the fees to watch out for, and how to do it safely and efficiently, so you're finally ready to pull the trigger on your very first crypto purchase. Alright, this is the moment of truth. It's the step where this whole thing starts to feel real. Because this is when your hard-earned money leaves the familiar comfort of your bank account and takes its first step into the world of digital assets. For many people, this is the most nerve-wracking part of the entire process. It's the digital equivalent of walking onto the airport jet bridge. You've left the terminal, but you're not on the plane yet. You're in between worlds. But don't worry. I'm going to walk you through this limbo, explain every option, and make sure your money gets to its destination safely, and just as importantly, without paying a penny more in fees than you absolutely have to. Let's talk about the 3 main bridges you can use to move your US dollars onto an exchange: the ACH transfer, the wire transfer, and the debit card purchase. Each one is a different tool for a different job, and picking the right one can save you a surprising amount of money and frustration. First up, we have the most common, the most popular, and for most beginners the best option, the ACH transfer. ACH stands for Automated Clearinghouse. That sounds complicated, but I promise you, you've used it dozens of times without even knowing it. If you've ever had a paycheck direct deposited, paid a bill online directly from your checking account, or transferred money using an app like Venmo, you've used the ACH network. It's the slow, steady, and reliable workhorse of the American banking system. When you link your bank account to an exchange like Coinbase or Kraken, this is the method they'll typically use. The process is usually seamless. You'll click Link Bank Account, and a secure window will pop up from a service called Plaid. Plaid is a trusted third-party company that acts as a secure middleman, allowing you to log into your bank through their portal, so the exchange can confirm your account without ever seeing or storing your bank password. It's safe, it's standard practice, and it's incredibly easy. So what are the pros of using ACH? The biggest one is the cost. It's almost always free. The exchange doesn't charge you to pull money from your bank, and your bank doesn't charge you to send it. This is huge. When you're starting out, you want every single dollar you invest to go towards your investment, not get chipped away by fees. Now the con. The one major downside to ACH is speed. It's not instant. It can take anywhere from 3 to 5 business days for the funds to fully clear and settle in your exchange account. Now here's a key detail many exchanges offer. They'll often give you instant buying power. This means the moment you initiate the transfer, they'll credit your account and let you buy crypto right away. They're basically fronting you the money because they're confident your transfer will clear. However, you won't be able to withdraw that crypto or send it off the exchange until the original ACH transfer officially settles a few days later. For 99% of beginners who are just looking to buy and hold, this is perfectly fine. So think of ACH as the tortoise. Slow, steady, reliable, and it wins the race on cost. Next, let's talk about the hare, the wire transfer. A wire transfer is a direct bank-to-bank transfer. It's the express lane of funding your account. If you need to move a larger sum of money, say several $1,000s or more, and you want it to be available for both trading and withdrawal as quickly as possible, a wire is your best bet. The funds will typically arrive and be fully settled in your account within the same business day, sometimes in just a few hours. The downside? It costs money. Your bank is going to charge you a fee to send a domestic wire, typically somewhere between $20 and $35. The exchange usually doesn't charge you to receive it, but that fee from your bank is unavoidable. This is a classic time is money scenario. You're paying a premium for speed and high limits. If you're investing $100, paying a $30 wire fee is insane. That's a 30% loss before you've even started. But if you're investing $20,000, that $30 fee is a tiny fraction of a percent, and it might be worth it for the peace of mind and speed. Now, a critical warning about wires. You have to be meticulous. The exchange will give you a set of instructions: their bank's name, a routing number, an account number, and most importantly, a unique reference number or memo code. This code is how they know the incoming money belongs to your account. If you forget that code or type it in wrong when you set up the wire with your bank, your money could end up in limbo, triggering a long and stressful customer support process to track it down. So if you go the wire route, measure twice, cut once. Copy and paste every detail with extreme care. Finally, we have the third option, the instant gratification button, the debit card. Using your debit card to buy crypto is exactly like ordering a pizza online. You put in your card number, expiration date, and security code, and boom, the transaction is done. The crypto is in your account instantly, fully cleared, and ready to go. It is without a doubt the fastest and easiest way to buy. So why doesn't everyone just do this? The fees. The fees are a killer. Exchanges will charge a hefty percentage for the convenience of a debit card transaction, often somewhere between 3% and 5%. On top of that, your bank might even classify it as a cash advance and slap on their own fees. Let's put that 4% fee in perspective. If you buy $1,000 worth of Bitcoin with your debit card, you could be paying a $40 fee right off the top. Your investment has to go up 4% just for you to break even. Over time, those fees act as a massive drag on your performance. So, when would you ever use a debit card? The only real scenario is if the market is crashing or pumping, and you see a price you feel you absolutely must get in that exact second, and you're willing to pay that premium for the speed. For a planned, thoughtful investment, it's almost always the worst choice financially. So let's recap and help you choose. For the vast majority of people starting out, ACH is your champion. It's free, it's secure, and the delay in withdrawing doesn't matter if your plan is to hold anyway. If you're a high roller moving a significant amount of cash and need it settled fast, the wire transfer is your tool. Just be prepared for the bank fee and double-check your details. And the debit card? Keep that in your back pocket for emergencies only, when the need for speed outweighs the certainty of a high fee. Once you've made your choice, the next step is straightforward. You'll log in, find the deposit, add funds, or transfer button. They make it very easy to find. You'll select US dollars, choose your method, and follow the on-screen instructions. For ACH, you'll link your bank. For a debit card, you'll enter your details. And for a wire, you'll be given that critical page of instructions to take to your own bank's website to complete the transfer. And then you wait. If you used a debit card, there's no wait. But if you chose ACH or a wire, there will be a period of time, maybe a few hours, maybe a few days, where your money is in transit. It has left the old world but hasn't quite arrived in the new one. This is a moment of anticipation. And it's the perfect time to prepare for the final step. Because getting the money there is only half the battle. Now you have to use it. Your funds are on the way. The bridge is being crossed. While that money is flying through the digital ether, we need to talk about what you're going to do the second it lands. We need to talk about placing your very first order. There's a right way to do it and a very, very wrong way that can cost beginners a fortune. We'll break down the confusing difference between a market order and a limit order, how to read a basic price chart so you don't buy at a terrible time, and the single biggest mistake people make in the heat of the moment when they finally click that buy button. Your money is almost in the account. Now let's make sure you use it like a pro. Alright, let's pull back the curtain on what the professionals do and what the amateurs, well, what they lose money doing. The moment you see your dollars land in that exchange account, your heart starts beating faster. You see the numbers on the screen flashing green, and the temptation to just throw your money at the first thing that's moving is immense. This is the first test, and most people fail it within minutes. Before you click a single button, you need to glance at one thing, the price chart. Now don't get scared. You don't need to be a Wall Street wizard with 6 monitors to understand the basics. Think of it like looking at a weather forecast before you leave the house. You just want to know if you're walking into a sunny day or a hurricane. When you look at the chart for Bitcoin or any crypto, you'll see a bunch of red and green bars. These are called candlesticks. It's incredibly simple. Green means the price went up during that time period, say that day. Red means the price went down. The longer the bar, the bigger the move. That's it. That's all you need to know for now. You're not trying to predict the future. You are simply trying to get context. Zoom out on the chart. Look at the last month or the last 3 months. You'll see peaks and valleys like a mountain range. The goal, in its most basic form, is to avoid buying at the very tip of the highest mountain peak. That's called buying the top. It's what happens when everyone is euphoric, the news is screaming about new all-time highs, and your cousin who knows nothing about finance is suddenly texting you about Dogecoin. That is typically the worst time to buy. Conversely, you'll see valleys or dips, times when the price has pulled back. These are often moments of fear or boredom in the market. As a beginner, simply training your brain to feel more comfortable buying when things are quiet or a little bit down, rather than when they are rocketing up in a frenzy, will save you a fortune. You don't need to catch the absolute bottom of the valley, nobody can, you just need to avoid the summit. A quick glance at the chart prevents you from making an obvious mistake, like buying something that has already shot up 50% in the last 24 hours. You're simply checking the weather. Okay, you've checked the chart. The coast looks reasonably clear. You've chosen your asset, let's say Bitcoin. You've decided you're going to invest $100. You navigate to the buy screen, and right there, you are faced with the single most expensive mistake a beginner can make. It's not buying the wrong coin. It's not even buying at the wrong time. It's how you buy. You'll see a big friendly glowing buy button, and next to it, you'll see an option, usually defaulted to something called a market order. A market order means, I want to buy this thing right now, and I will pay whatever the current price is. I don't care. Just get me in. In the heat of the moment, with the price jumping around, 99% of beginners slam the market buy button. And in doing so, they give up all of their power. Here's why that's a disaster waiting to happen. The price you see on the screen is not always the price you get. It's the last traded price. But in a fast-moving market, by the time your order travels from your computer to the exchange's servers and gets matched with a seller, the price could have changed. This is called slippage. Imagine you're at an auction. An item is at $100. You scream, I'll take it. But in that same split second, two other people also screamed, and the auctioneer now says the price is $103. A market order says, fine, I'll pay $103. Or $104. Or whatever it takes to get the order filled instantly. You're essentially telling the exchange, here's a blank check. Fill it in for me at whatever price you can find. During a crazy price surge, that slippage can cost you a significant percentage. You thought you were buying at $50,000, but your order actually gets filled at $50,500. You instantly lost money because you were impatient. So what do the pros do? They almost never use market orders. Instead, they use the other option, the one that puts them in complete control, the limit order. A limit order is you telling the exchange, I want to buy this asset, but I refuse to pay a single penny more than this specific price. You set the limit. You are the boss. Let's go back to our example. Bitcoin is trading at, say, $50,100. It's bouncing around. Instead of a market buy, you select limit buy. The exchange will then ask you for your limit price. This is the maximum you are willing to spend per coin. You look at the price and say, I don't want to chase it. I'm willing to buy it if it comes back down to $50,000 even. So you type in $50,000 as your limit price. Then you enter that you want to buy $100 worth. You click confirm. And what happens? Nothing. Immediately, at least. Your order is now sitting in the exchange's order book, waiting. It's a patient hunter. If the price of Bitcoin continues to go up to $51,000, your order does nothing. You didn't get caught up in the hype. You didn't overpay. If the price chops around and then dips back down, the moment it touches $50,000 or lower, your order will automatically execute at the best available price up to your limit. Bang! You bought your Bitcoin at the price you dictated, not at the price the frantic market dictated for you. This is a fundamental shift in mindset. You go from a reactive, emotional chaser to a disciplined, patient strategist. Using a limit order is the first true step to acting like an investor instead of a gambler. It forces you to think about what price you're actually comfortable paying, and it protects you from the expensive mistake of slippage. Now there's one more professional level strategy we need to cover, and it's arguably the most powerful long-term wealth-building tool in all of investing. It takes the idea of using limit orders one step further by removing the impossible task of trying to perfectly time your buys. It's called dollar cost averaging, or DCA. The concept is brilliantly simple. Instead of trying to figure out if today is the absolute best day to buy, you ignore the daily price swings entirely. You commit to investing a fixed amount of money on a fixed schedule. For example, you decide you're going to buy $50 worth of Bitcoin every single Friday no matter what. If the price is high one week, your $50 buys you a little less Bitcoin. If the price crashes the next week, your $50 buys you a whole lot more Bitcoin. Over months and years, your purchase price averages out. You're not trying to be a hero and time the bottom. You're just consistently accumulating. This strategy crushes the two biggest enemies of the investor: fear and greed. When the market is crashing and everyone is panicking, your automated buy order executes. You're buying on sale. When the market is euphoric and everyone is piling in at the top, your automated buy order executes, but it's just your normal small amount protecting you from going all in at a terrible price. It turns market volatility, which terrifies most people, into your friend. And the best part? Almost every major exchange in the US, like Coinbase or Kraken, allows you to set this up automatically. You can link your bank account and create a recurring buy. Set it to $25 every Monday, or $100 on the first of every month, and the exchange does the work for you. It is the single most effective way to remove emotion from your investment process and build a serious position over time without driving yourself crazy staring at charts. So let's put it all together. You funded your account. You glanced at a chart to make sure you're not buying at the top of a cliff. You've decided to use a limit order to control your entry price, or even better, you've set up a recurring buy to dollar cost average and play the long game. You've clicked confirm. The order fills. Congratulations! You now officially own a piece of cryptocurrency. It's sitting right there in your exchange account balance. But this brings us to the most important and most misunderstood part of this entire world. That crypto sitting on the exchange, is it really truly yours? Is it safe? The answer might shock you, and it's what separates the people who own crypto from those who are merely holding an IOU from a company that could disappear tomorrow. This is the single most important concept you will ever learn in your crypto journey. And getting it wrong is the #1 reason people lose their life savings. The crypto you bought on Coinbase, on Kraken, on Gemini, it is not technically in your possession. You don't own the crypto. You own a promise from that company, an IOU, that says they are holding that crypto on your behalf. You see, when you use a traditional bank, your money is FDIC insured up to $250,000. If the bank goes under, the government steps in to make you whole. In the world of crypto, there is no such safety net. If that exchange gets hacked, if the founders run off with the money, if the company declares bankruptcy, your crypto is gone. Forever. Think of the exchange as a coat check at a fancy restaurant. You hand over your expensive coat, and they give you a little paper ticket. That ticket says you own the coat, but the restaurant is the one holding it. You are trusting them to keep it safe. But what if there's a fire? What if a dishonest employee steals it? What if the whole restaurant shuts down and the owners disappear? Your ticket is worthless. You've lost your coat. This isn't some made-up scenario. This is the exact story of Quadriga CX, where the founder supposedly died with the only passwords, locking away $190 million of customer funds. It's the story of Mt. Gox, the original Bitcoin exchange that was hacked, wiping out 850,000 Bitcoins, worth nearly $500 million at the time, and tens of billions today. And most recently, it's the story of FTX, a company that looked like the most trustworthy institution in the space, with celebrity endorsements and stadium naming rights, that collapsed overnight, evaporating $8 billion of customer money because they were gambling with it behind the scenes. People who thought they were crypto millionaires woke up with zero. This is the central risk of leaving your assets on an exchange. It's convenient, yes, but you are outsourcing your security to a third party. You are trusting them completely. The foundational principle of cryptocurrency, the entire reason Bitcoin was created, was to eliminate the need for trusted third parties. It was designed so that you, and only you, could be in complete control of your own money. So how do you do that? How do you take your crypto off the coat check and truly own it yourself? The answer is by using a crypto wallet. Now, the word wallet is a little misleading. Your leather wallet holds physical cash. A crypto wallet doesn't actually hold your coins. Your coins, your Bitcoin or Ethereum, never leave the blockchain. They always exist on that global, distributed ledger we talked about. A crypto wallet is more like a special secure key ring. It holds the keys that prove you are the owner of specific coins on that blockchain. It gives you the power to access them and send them wherever you want. And this brings us to the most famous saying in all of crypto: not your keys, not your coins. If you don't control these keys, you don't control your crypto. Period. The exchange holds the keys for you. When you use your own wallet, you hold the keys. There are two main categories of wallets you need to know about: hot wallets and cold wallets. Let's start with hot wallets. A hot wallet is a piece of software that lives on your computer or your phone. Think of apps like MetaMask, Trust Wallet, or Exodus. They are called hot because they are connected to the internet. This is what makes them incredibly convenient. You can quickly connect to decentralized applications, buy NFTs, or trade on decentralized exchanges. A hot wallet is like the cash you keep in your physical wallet in your pocket. It's great for everyday spending and easy access. But you wouldn't walk around with your entire life savings in your pocket, would you? Of course not, because it's more exposed to risk. A pickpocket could steal it. Similarly, because a hot wallet is always online, it has a theoretical risk of being compromised by malware, viruses, or sophisticated phishing scams on your computer. It is a massive leap forward in security compared to an exchange because you hold the keys. But it's designed for convenience over maximum security. For the crypto you plan to actively use, a hot wallet is a fantastic tool. But what about the crypto you want to hold for the long term? Your nest egg? The digital equivalent of the gold bars you'd lock away in a high-security vault? For that, you need a cold wallet. A cold wallet, also known as a hardware wallet, is a small physical device, usually looking like a USB stick. The most popular brands are Ledger and Trezor. This device is the ultimate in crypto security. Here's why. It generates and stores your precious private keys completely offline. It is never exposed to the internet. When you want to make a transaction, say send some Bitcoin from your secure vault, you plug the device into your computer. You prepare the transaction on your computer screen, but the final critical step of signing and approving that transaction happens on the device itself. You physically press a button on the little device to confirm. This means that even if your computer was riddled with the worst viruses known to man, a hacker watching your every move could not steal your funds. They can't press that physical button on the device sitting on your desk. This physical separation is what makes cold storage the gold standard for securing any significant amount of cryptocurrency. It's like having a bank vault in your home that only you can open. So, you have your exchange account, which is like a coat check. You have a hot wallet, which is like your pocket wallet for daily use. And you have a cold wallet, which is like your personal Fort Knox for long-term savings. The professional strategy is to use all three, moving funds between them based on your needs. But there's one more piece to this puzzle, the most critical piece of all. When you set up your own wallet for the first time, whether it's a hot or cold wallet, it will generate something called a seed phrase, or recovery phrase. This is a list of 12 or 24 simple, randomly generated words. Words like ocean, anchor, victory, mountain. This sequence of words is the master key to your entire crypto kingdom. It is the backup that can restore your wallet and all of your funds on any new device anywhere in the world. If you lose your phone with your hot wallet on it, you can use those 12 words to get it all back. If your house burns down with your cold wallet device inside, you can buy a new one, enter your 24 words, and all of your crypto will be there safe and sound. This means that this seed phrase is the most sensitive piece of information you will ever own. You must guard it with your life. You write it down on a piece of paper, never ever ever store it digitally. Do not take a screenshot of it. Do not save it in a text file on your computer. Do not email it to yourself or save it in a password manager. Any of those things could be hacked. You write it down, make multiple copies, and store them in safe, separate physical locations. And you never, under any circumstances, share it with anyone. No exchange, no wallet company, no support technician will ever ask you for your seed phrase. Anyone who does is a scammer trying to steal everything you own. Giving someone your seed phrase is like giving them the signed title to your house, the keys to your car, and the PIN to your bank account all at once. It is absolute irreversible power over your funds. You are now armed with the knowledge that separates casual beginners from serious investors. You understand the difference between a custodial IOU and true self-sovereign ownership. You know about the convenience of hot wallets and the fortress-like security of cold wallets. And you understand the ultimate power and responsibility that comes with your secret 12 words. The theory is done. Now it's time to put it into practice. How do you actually create one of these digital vaults? How do you safely transfer your first crypto from the exchange into a wallet that you, and only you, control? In the next part, we're going to walk through that process step by step, click by click, ensuring you do it right the very first time. So you've done it. You've navigated the exchange, you've made your first purchase, and you're now the proud owner of some cryptocurrency. You can see it right there in your account balance. But I have to tell you a hard truth. Right now, in this moment, that crypto isn't truly 100% yours. It's like having gold stored in a bank vault that the bank manager can access. Sure, your name is on the account, but you don't hold the key. In the world of crypto, there's a saying that is repeated like a mantra, and you need to burn it into your brain. Not your keys, not your crypto. Right now, the exchange holds the keys. They are the custodian. And while major US-based exchanges are generally very secure, you're still trusting a third party. The entire point of cryptocurrency, the philosophical revolution behind it, is to eliminate that need for trust. It's about self-sovereignty. It's about you becoming your own bank. So, the most critical next step in your journey is moving your assets off the exchange and into a wallet that you, and only you, control. This is the part that scares a lot of people. Feels technical, it feels risky. What if you mess up? What if you send it to the wrong place? Relax. We are going to do this together, slowly and methodically. By the end of this, the fear will be replaced by a feeling of empowerment you've probably never felt before with your finances. First, let's understand what a wallet is. There are two main types you'll hear about: hot wallets and cold wallets. A hot wallet is a piece of software connected to the internet. It lives on your computer or your phone. It's convenient, it's easy to access, and it's the perfect first step for taking self-custody. A cold wallet or hardware wallet is a physical device like a USB stick that keeps your keys completely offline. It's the Fort Knox of crypto security. We'll get to that later in the series as it's the ultimate goal. But for now, let's start with a hot wallet. It's the ideal training ground. We're going to use a very popular beginner-friendly software wallet called Exodus as our example. The principles we learn here will apply to almost any software wallet you choose, whether it's MetaMask, Trust Wallet, or another. The first and most important step is downloading the software. Go directly to their official website. Do not, under any circumstances, search for it in an app store and click the first link, or click on a pop-up ad. Scammers create fake, malicious copies of these wallets to steal your funds. Go to the official source, double-check the URL, and download it from there. Once you've installed it and you open it for the first time, you'll be prompted to create a new wallet. The software will generate something for you that is the single most important piece of information you will ever be given in your crypto life. It's called a seed phrase or a recovery phrase. It will be a list of 12, or sometimes 24 simple English words in a specific order. I need you to stop and listen to me very carefully. This is not a password. This is not a username. This is everything. These 12 words are the master key to your crypto. Anyone in the world who gets access to these 12 words in the correct order can take every single cent you own, from anywhere on the planet, and there is no bank, no government, and no customer service line you can call to get it back. It will be gone forever. Conversely, if your computer explodes, if your phone falls into the ocean, if your house burns down, as long as you have these 12 words, you can download that wallet software onto any new device in the world, enter the phrase, and your funds will reappear perfectly safe. This phrase is your money. So what do you do with it? You write it down. With a pen. On a piece of paper. Or 2 pieces of paper. Or 3. You are going to store this phrase offline in the physical world. Never, ever, ever type it into a computer file. Don't save it in your Notes app. Don't email it to yourself. Don't take a screenshot of it. Don't take a photo of it. Any digital copy of your seed phrase is a target for hackers. It is the #1 way people lose their life savings in crypto. Write it down, double-check the spelling of every word, and number them from 1 to 12. Store 1 copy in a safe at home. Maybe store another copy in a safe deposit box, or give it to a trusted family member in a sealed envelope. People have etched their seed phrases into steel plates to make them fireproof and waterproof. That's how seriously you need to take this. Treat these 12 words like they are a block of pure gold, because they are. The wallet software will then ask you to confirm your phrase to make sure you wrote it down correctly. Once you do that, your wallet is created. Congratulations! You now have your own personal, private, uncensorable vault on the blockchain. Right now it's empty. Let's change that. Inside your wallet, you'll see a list of cryptocurrencies like Bitcoin, Ethereum, and others. Let's say you bought Ethereum on the exchange. You'll click on Ethereum inside your Exodus wallet, and you'll see 2 big buttons: Send and Receive. We want to receive funds, so click Receive. The wallet will now show you a long string of letters and numbers. This is your public wallet address. Think of this like your bank account number. It's perfectly safe to share this address with others. This is how people can send you crypto. It is mathematically linked to your seed phrase, but it is impossible for anyone to reverse engineer your seed phrase from this public address. This is the magic of cryptography. Now copy that receiving address. The wallet will have a little copy button right next to it. Now we go back to the exchange where you bought your crypto. Log in, go to your portfolio, and find the crypto you want to withdraw. You should see an option that says Send, Withdraw, or Transfer. Click it. It will ask you for two things: an amount and an address to send it to. This is where you paste the receiving address from your Exodus wallet. And now we perform the single most important habit for any crypto transaction. We verify the address. Do not just trust that your copy and paste worked correctly. There is malicious software that can hijack your clipboard and replace the address you copied with a hacker's address. So, you go back to your Exodus wallet and look at the address. Then go back to the exchange and look at the address you pasted. Check the first 4 or 5 characters. Do they match? Good. Now check the last 4 or 5 characters. Do they match? Excellent. If they both match, you are good to go. But we are not going to send everything at once. Not the first time. We are going to do a test transaction. This is a non-negotiable rule for beginners. In the amount field, you're going to send a tiny amount. $5, $10. An amount that you would not be upset to lose if you somehow messed this up. Think of it as a small one-time insurance payment for your peace of mind. You'll enter that small amount, you'll have your double-checked address pasted in, and you'll hit send. The exchange will likely ask you for some two-factor authentication to confirm. Once you approve it, the transaction is sent. Now you wait. A blockchain transaction isn't instant like a text message. It has to be picked up by miners or validators, included in a block and confirmed on the network. This can take anywhere from 30 seconds to 10 minutes or more, depending on the crypto and how congested the network is. Don't panic. Just be patient. Open up your Exodus wallet, and you watch. And then it happens. You'll get a notification. You'll see the balance update. That $5 or $10 you sent has arrived. It's there. In your wallet. A wallet that only you have the keys to. Take a moment and feel that. That feeling is the entire point. It's the feeling of true financial sovereignty. Now that you've successfully completed the test transaction, you know the address is correct and the process works. You can now repeat the exact same steps, checking the address again out of pure habit, and send the rest of your crypto from the exchange to your wallet. You've done it. You've taken your assets out of the bank and put them into your own private vault. You have graduated from being a crypto speculator to a true self-custodian. Your crypto is now safer than it was before. It's in a digital fortress where you are the sole gatekeeper. But what if I told you there's a way to take that digital fortress and encase it in a physical one? A way to take your keys completely offline, making them virtually immune to online hackers? That's the next level of security, and it's where we're going next. This is the realm of cold storage, and the key to this kingdom is a device called a hardware wallet. Think of it as a specialized, highly secure USB drive, but instead of storing photos or documents, it stores the one thing that truly matters in crypto: your private keys. It keeps them in a state that is completely cold, meaning disconnected from the internet and all its dangers. Your phone wallet, your desktop wallet, the wallet inside your exchange account, those are all hot wallets. They're connected to the internet for convenience. A hot wallet is like the cash you keep in your pocket. It's great for daily transactions, easy to access, but you would never walk around with your entire life savings stuffed in your jeans. Why? Because it's exposed. It's vulnerable. A pickpocket, a mugger, or in the digital world, a hacker, a virus, a phishing scam could take it all in an instant. A hardware wallet, on the other hand, is your personal Fort Knox. It's the vault where you store your gold bars, your bearer bonds, your digital inheritance. The beauty of it is that your private keys are generated on the device and they never ever leave it. They never touch your computer, they never touch your phone, and they certainly never touch the internet. This is a fundamental concept to grasp. Your computer can be riddled with viruses, spyware, and keyloggers. It could be completely compromised by a hacker on the other side of the world, and they still wouldn't be able to steal your crypto from your hardware wallet. So how does this magic work? How can you make a transaction if the keys are offline? It's a beautifully elegant process. When you want to send some Bitcoin, for example, you connect your hardware wallet to your computer. You use a companion app on your computer to create the transaction. You'll input the recipient's address and the amount you want to send. Now here's the critical part. The app sends this unsigned transaction data over to the hardware wallet. Inside the wallet, a secure, specialized chip takes that data and signs it using your private key. This signature is the cryptographic proof that you, and only you, have authorized this transaction. But before it signs, the device will show the transaction details on its own tiny, trusted screen. It will say, "Are you sure you want to send 0.5 Bitcoin to this address?" You then have to physically press a button on the device itself to confirm. This physical confirmation step is the kill switch for hackers. A remote attacker can't press a physical button on a device sitting on your desk. They can watch your screen, they can log your keystrokes, but they cannot bridge that physical gap to approve the transaction. Once you press that button, the signed transaction, which is now safe to be public, is sent back to the computer, which then broadcasts it to the Bitcoin network. Your keys never left the vault. Let's make this real. Imagine two people, Alex and Ben. Both bought 5 Bitcoin back when it was affordable. Alex, prioritizing convenience, kept his on the exchange where he bought it. Ben, prioritizing security, immediately moved his to a Ledger hardware wallet he bought directly from the manufacturer. A year goes by. The exchange Alex used suffers a massive, sophisticated hack. One morning, Alex wakes up to a notification. The exchange has frozen all withdrawals. A few days later, the devastating news breaks. The funds are gone. Stolen. Alex's 5 Bitcoin, his entire investment, vanished into thin air. He is left with nothing but a claim in a decade-long bankruptcy proceeding. He trusted a third party, and that trust was broken. Now consider Ben. That same week, Ben gets a very convincing email that looks like it's from his hardware wallet company, Ledger. It says there's a security update, and he needs to enter his 24-word recovery phrase on a website to upgrade his wallet. Ben, being a little careless, clicks the link. It's a phishing scam. The moment he types in that phrase, the hacker on the other side has the master key to his entire crypto fortune. They can drain his wallet instantly, and Ben loses everything. Wait, that's not how the story is supposed to go, right? Let me tell you what actually happened to Ben. Ben got the same phishing email, but because he had listened to advice just like this, a massive alarm bell went off in his head. He knew the one unbreakable rule. Never ever type your recovery phrase into any digital device. Not a website, not a text file, not an email. That phrase is for recovery only, to be entered directly into a new hardware wallet, and nothing else. He deleted the email, and his 5 Bitcoin remained perfectly safe, locked away on his device, completely immune to the online attack. The difference between financial ruin and financial sovereignty for Ben wasn't luck. It was a 10-minute setup process and a $50 device. This brings us to the most important part of this entire guide. If you are holding an amount of cryptocurrency that you would be devastated to lose, you need to stop what you are doing and order a hardware wallet. Don't finish this video first. Pause it, go to the official website for Ledger or Trezor, those are the 2 most reputable brands, and order one. Do not, under any circumstances, buy one from Amazon, eBay, or any other third-party reseller. These devices can be tampered with. A scammer can buy a wallet, open it, set it up so they already know the recovery phrase, then shrink wrap it and sell it as new. The moment you transfer your funds to it, they drain it. Buy direct from the manufacturer. Period. When your wallet arrives, your real journey begins. The setup is your coronation as a sovereign individual. First, you'll unbox it and initialize it. The device itself will generate your private keys, and then it will present you with your 24-word recovery phrase. This phrase is everything. It is the master key that can restore your crypto on any other compatible device if yours is lost, stolen, or smashed with a hammer. You must write these words down on the paper card they provide. Then you must think like a spy. Where do you hide this information? You never ever save it digitally. Don't take a picture of it. Don't type it into a notes app. Don't email it to yourself. If a hacker gets into your phone or your cloud account, they have your money. You must store that physical piece of paper somewhere safe. A fireproof safe. A bank safe deposit box. Some people even stamp the words into a piece of metal to protect against fire and flood. You should make 2 or 3 copies and store them in different secure geographic locations. This is your responsibility now. There is no customer service number to call if you lose this phrase. There is no forgot password link. You are the bank, and these are the keys to the vault. Lose the keys, you lose the money. Forever. After you've secured your phrase, you'll set a PIN code for the device. This protects it if someone physically steals it. Without the PIN, the device is useless to them. Now for the pro tip, the one thing that will let you sleep at night. Before you move your life savings over, do a test run. Send a tiny, insignificant amount, say $20 worth of crypto, from the exchange to your new hardware wallet address. Verify it arrives. Then take a deep breath and deliberately wipe the hardware wallet, resetting it to factory settings. Now go through the recovery process. Use your 24-word phrase to restore your wallet. If that $20 reappears, you have 100% confirmation that your backup works. You have personally verified that you wrote down the words correctly and that you know how to restore your funds from scratch. Only then, with that confidence, should you proceed to move the rest of your holdings. To do that, you'll open the Wallets app, click Receive, and it will generate a new address for you. The most important security check is to ensure the address displayed on your computer screen exactly matches the address displayed on the tiny screen of your physical hardware wallet. Malware can change an address on your computer screen without you knowing. By cross-referencing with the trusted offline device, you guarantee you're not sending your funds to a hacker. Once verified, you copy that address, go to your exchange, paste it into the withdrawal field, and send your crypto home to your vault. The feeling of seeing that transaction confirm, knowing your assets are finally offline, under your control, and secured by you and you alone. It's a profound shift. You're no longer just a user of a financial system. You are your own financial system. You've built the fortress and locked the gate. But now that your assets are secure, what do you do with them? How do you think about growing your portfolio? Security is the foundation, but strategy is how you build the skyscraper. And that, my friends, is where we're headed next. So let's talk about building that skyscraper. An investment portfolio isn't just something that happens. It's designed. It's architected. And you are the architect. The first and most powerful tool in your architectural toolkit is a concept so simple, yet so profoundly effective, that 99% of professional traders can't beat it over the long run. It's called dollar cost averaging, or DCA. Forget trying to time the market. Forget staring at charts until your eyes bleed. Trying to predict the absolute perfect moment to buy. Trying to catch the bottom is a fool's game. It's like trying to catch a falling knife in the dark. You're far more likely to get hurt than you are to succeed. Dollar cost averaging is the antidote to this madness. Here's how it works. You commit to investing a fixed amount of money at a regular interval, no matter what the price is. Could be $50 every Friday, $100 on the first of every month. The amount and the frequency don't matter as much as the consistency. When the price is high, your fixed amount buys you fewer coins. When the price is low, that same fixed amount buys you many more coins. Over time, this strategy smooths out the wild volatility of the crypto market. You're not making one big emotional bet. You're making a series of small, disciplined, unemotional decisions. Think of it like a river carving its way through a canyon. It's not one massive flood that does the work. It's the steady, relentless, consistent flow of water over thousands of years. That is the power of DCA. It removes your greatest enemy from the equation: your own emotion. Your fear when the market crashes, and your greed when it skyrockets. The system is automatic. You just set it and let it work its magic. Most major exchanges in the US, like Coinbase or Kraken, allow you to set up recurring buys. This is financial discipline on autopilot. Now, once you're automatically accumulating, what are you accumulating into? This brings us to the second principle, the HODL philosophy. HODL, which started as a typo for hold in an old Bitcoin forum, has become a rallying cry for long-term believers. It means hold on for dear life. This isn't about day trading or swing trading. This is about conviction. It's the recognition that you are investing in a revolutionary technology that is still in its early innings. People who bought Amazon stock in 1999 didn't get rich by selling it in 2001 when the dot-com bubble burst and the stock fell over 90%. They got rich because they understood the internet was changing the world. They believed in the company's vision, and they held on through a decade of brutal volatility. Hodling in crypto is the same mindset. It requires patience. It requires you to do your research, believe in the fundamental value of what you own, be it Bitcoin as a store of value or Ethereum as a decentralized world computer, and have the stomach to ignore the short-term noise. The market will have terrifying drops. It will have euphoric peaks. A hodl strategy means you zoom out. You look at the 5-year or 10-year chart, not the 5-minute chart. You're not a speculator. You're an early investor in a new technological paradigm. But holding just one asset, even a great one, can be risky. This is where our third principle comes in: smart diversification. You've heard, don't put all your eggs in one basket. In crypto, this is crucial, but it comes with a major warning. Diversifying doesn't mean buying 100 different cheap, random coins hoping one of them goes to the moon. That's not a strategy, that's gambling. That's called diversification, because you often end up just buying a lot of junk that goes to zero. Smart diversification is about building a balanced portfolio across different sectors of the crypto economy. Think of it like this: Bitcoin is your foundation. It's the digital gold, the most secure, decentralized, and established network. It's the least risky asset in a very risky asset class. A significant portion of your portfolio, especially as a beginner, could be allocated here. Then you have Ethereum. This is like the first floor of your skyscraper. It's the dominant smart contract platform where most of the innovation in DeFi, NFTs, and Web3 is being built. It has a different value proposition than Bitcoin. It's not just digital gold. It's a decentralized global software platform. From there, you might consider adding a small, calculated allocation to other promising sectors. Maybe a competing Layer 1 blockchain that's trying to solve Ethereum's scalability problems. Or a project in a specific niche you believe in, like decentralized data storage or gaming. The key is that every single asset you buy must have a reason to exist. You should be able to explain in 1 or 2 sentences what it does and why it has long-term value. If you can't, you shouldn't own it. Start with the blue chips, Bitcoin and Ethereum, and only venture out once you've done extensive research. So you have your DCA strategy feeding into a diversified, long-term hold portfolio. What's next? The fourth principle is a bit more advanced, but it's what separates amateurs from serious investors. Rebalancing. Imagine your portfolio is 60% Bitcoin and 40% Ethereum. But then Ethereum has an incredible year and its value skyrockets. Now, your portfolio might be 40% Bitcoin and 60% Ethereum. You're now more exposed to the risk of Ethereum than you originally planned. Rebalancing is the simple act of selling some of the asset that has performed well to bring your portfolio back to its original target allocation. In this case, you would sell some Ethereum and use the proceeds to buy more Bitcoin, getting you back to that 60-40 split. This might feel counterintuitive. Why would you sell your winner? But look at what it forces you to do. It systematically makes you sell high and buy low. It takes the profits from your high flyers and reinvests them into your underperforming assets, all while keeping your risk level in check. You can do this on a schedule, say once every quarter or once a year. It's a disciplined way to manage your portfolio's growth and risk without emotion. These 4 principles, DCA, HODL, diversification, and rebalancing, are the architectural plans for your skyscraper. But there's one more thing, perhaps the most important thing of all. It's the psychology, the mental game. You can have the perfect strategy, but it's worthless if you panic and abandon it at the first sign of trouble. The crypto market is designed to shake you out. It will test your resolve. You will experience FUD fear, uncertainty, and doubt. When news headlines are screaming that crypto is dead and your portfolio is down 50%, your gut will tell you to sell everything to stop the bleeding. And you will experience FOMO, fear of missing out, when a random meme coin is up 10,000% and everyone on social media is posting about their new Lamborghinis. Your gut will tell you to mortgage your house and go all in. Your strategy is your shield against these emotions. Your plan, which you make now with a clear and rational mind, is your defense against the irrational panic or greed you will inevitably feel later. Write it down. Why did you buy these assets? What is your time horizon? What will you do if the market drops 50%? What will you do if it doubles? Answering these questions before they happen is the key to surviving and thriving. And that leads to the final, most personal question you must ask yourself as an architect of your own wealth. What is this skyscraper for? What is your goal? Is it to save for a down payment on a house in 5 years? Is it for a retirement fund in 30 years? Is it to have a small speculative pot of money you can afford to lose? Your goal defines your entire strategy. It dictates your risk tolerance, your time horizon, and most importantly, your exit plan. Because getting rich on paper doesn't mean anything until you realize those gains. Having a clear why is the North Star that will guide every decision you make. It turns abstract numbers on a screen into a tangible future you are building, brick by brick, deposit by deposit. You now have the framework. You've secured your foundation with a hardware wallet, and you have the architectural blueprints for a sound investment strategy. You know how to build. You know how to think for the long term. You have the tools, the mindset, and the plan. But even the most perfectly constructed skyscraper, with the strongest foundation and the most brilliant design, can be threatened by one external force that most builders forget to account for until it's too late. An unavoidable reality that can take a huge chunk out of your hard-earned gains if you're not prepared. And navigating that landscape is the final critical step to truly cementing your financial future in this new world. So let's talk about the one topic that makes even the most seasoned investors break into a cold sweat: taxes. In the United States, the Internal Revenue Service, the IRS, has made one thing crystal clear. They are paying very, very close attention to cryptocurrency. And ignoring this reality is like trying to ignore gravity. Sooner or later, it will catch up with you. But here's the secret. Understanding crypto taxes isn't about fear. It's about strategy. It's the final piece of the puzzle that transforms you from a casual buyer into a savvy investor who protects their profits. First, you have to understand the fundamental rule that governs everything else. In the eyes of the IRS, cryptocurrency is not treated as currency, like the US dollar. It's treated as property. This is the most important sentence in this entire section. Because it's property, every time you dispose of it, you're subject to capital gains tax rules, exactly like you would be if you sold stocks, a piece of art, or a second home. This means the government wants to know two things: what you paid for it and what you sold it for. The difference is your gain or your loss. So when exactly do you trigger what's called a taxable event? This is where most people get tripped up. The first one is obvious. Selling your crypto for US dollars. You bought one Bitcoin for $30,000, and you sell it a year later for $60,000. You have a $30,000 capital gain that you need to report. Simple enough. But here's the one that catches almost everyone by surprise. Trading one cryptocurrency for another. Let's say you have that one Bitcoin you bought for $30,000. It's now worth $60,000, and you decide to trade it for 30 Ethereum. In the eyes of the IRS, you didn't just swap one asset for another. You effectively sold your Bitcoin for $60,000, realizing a $30,000 gain, and then immediately used that $60,000 to buy 30 Ethereum. That trade, that single click, was a taxable event. Every single time you swap one coin for another, you are technically selling the first one, and you have to calculate the gain or loss on it at that exact moment. This applies to thousands of coins on hundreds of exchanges. You can see how this can become a tracking nightmare very, very quickly. The third major taxable event is using cryptocurrency to buy goods or services. That story about the guy who bought 2 pizzas for 10,000 Bitcoin? That would be a modern tax catastrophe. If you buy a $5 coffee using crypto that you originally bought for just $1, you have realized a $4 capital gain. You technically sold your crypto for the $5 value of the coffee. While this is less common for everyday purchases right now, it's a critical rule to understand as crypto becomes more integrated into our economy. Finally, receiving crypto as a form of income is also taxable. If you're a miner and you earn new coins, or if you're staking your crypto and receiving rewards, or even if you receive an airdrop of new tokens, that's all considered income. You must report the fair market value of the crypto on the day you received it as ordinary income. Then, that value becomes your starting point, your cost basis for when you eventually sell or trade it later. So what isn't a taxable event? Thankfully, a few things. Simply buying and holding crypto is not taxable. You don't owe anything until you sell, trade, or spend it. Transferring crypto between your own wallets, say from your Coinbase account to your personal Ledger hardware wallet, is not a taxable event. You're just moving your own property from one pocket to another. Gifting crypto to someone is also generally not taxable, up to the annual gift tax exclusion limit, which is over $17,000 per person as of 2024. Now let's get to the most important part: how the government taxes your gains. It all comes down to how long you held the asset. If you held your crypto for 1 year or less before selling or trading it, that's a short-term capital gain. Short-term gains are taxed at your ordinary income tax rate, the same rate as your salary from your job. This can be quite high, potentially 24%, 32%, even 37%, depending on your income bracket. But, and this is a huge but, if you hold your crypto for more than 1 year, it becomes a long-term capital gain. And long-term capital gains are taxed at much, much lower preferential rates. For most Americans, that rate is either 0% or 15%. For high earners, it's 20%. Think about that. By simply holding an asset for 1 day longer than a year, you could cut your tax bill on the profits by more than half. This is the single most powerful tax-saving strategy available to a crypto investor: patience. The HODL mentality isn't just a meme. It's a brilliant tax strategy. Okay, this all sounds incredibly complicated to track. How are you supposed to remember the US dollar value of every single trade you made all year? The answer is, you don't do it manually. That way lies madness. The solution is technology. First, your exchange. Major US-based exchanges like Coinbase and Kraken are now required to issue a tax form called a 1099-B, which details your gains and losses. This makes things much easier for simple transactions. However, if you use multiple exchanges, DeFi protocols, or self-custody wallets, these forms won't capture the whole picture. This is where crypto tax software comes in. This is the real pro-level move. Services like Coinly, CoinTracker, and TaxBit are lifesavers. You connect your exchange accounts and public wallet addresses via an API, and the software automatically pulls in all of your transaction data. It crunches the numbers, calculates your short-term and long-term gains and losses across all your platforms, and generates the exact IRS forms you need to file your taxes, like Form 8949. The small annual fee for one of these services can save you hundreds of hours of work and potentially thousands of dollars in tax mistakes. It is an absolute non-negotiable tool for anyone even moderately active in crypto. When you file your taxes, you'll now see a question right on the front of the main Form 1040. At any time during the year, did you engage in a transaction involving virtual currency? For you, the answer will now be yes. And the forms generated by your tax software will provide all the backup detail the IRS requires. And here's one final powerful strategy: tax loss harvesting. If you have some investments that are down, you can sell them at a loss to offset your gains from other investments. Let's say you have a $10,000 gain from selling Bitcoin, but you also have a $4,000 loss on an altcoin that didn't pan out. You can sell that altcoin, realize the $4,000 loss, and use it to reduce your taxable Bitcoin gain to just $6,000. You can even deduct up to $3,000 in net losses against your regular income each year. It's a way to turn your losses into a strategic advantage. Look, I have to say this one more time very clearly. I am not a tax advisor, and this is not financial or tax advice. This is for educational purposes only. For your specific situation, especially if it's complex, you absolutely must consult with a qualified CPA or tax professional who understands the nuances of digital assets. It's the best money you'll ever spend to ensure you're compliant and that you're keeping as much of your hard-earned profit as legally possible. And with that, our journey is complete. We've gone from the very birth of Bitcoin to understanding the intricate dance of public and private keys. We've walked through setting up an exchange account, making your first purchase, and securing your assets offline in a hardware wallet. We've explored the universe of altcoins and the importance of doing your own research. And now we've tackled the final boss, taxes. You now have a complete step-by-step blueprint. You have more knowledge than 99% of people on the planet about this revolutionary technology. This isn't just a guide to buying a new asset. It's a toolkit for participating in what could be one of the most significant financial shifts of our lifetime. The path from here is yours to walk. It will be volatile, it will be exciting, and it will undoubtedly be full of surprises. But you will no longer be walking it in the dark. You are prepared. If this series has given you the knowledge and the confidence to take your first step into this new world, do me a favor and hit that subscribe button, because our exploration of this financial frontier is far from over. Share this with one person you know who is curious but hesitant. And finally, let me know in the comments, what was the single most valuable thing you learned throughout this entire series? Thank you for taking this journey with me. The future is here. Let's build it together.